Okay, let's dive right into this explainer and see if we can unravel what is honestly a pretty fascinating market mystery. Have you ever been looking at the news and just thought to yourself, wait a second, the demand for artificial intelligence is absolutely booming right now, so why on earth are AI stocks suddenly dropping? I mean, it seems like a massive contradiction, right? Well, today we're going to unpack exactly what's going on behind the scenes of this recent market movement. We're going to separate the flashy headlines from reality and really dig into the underlying mechanics driving these valuations.
We're essentially putting on our financial detective hats today, because let me tell you, the headline numbers absolutely do not tell the whole truth about what is happening under the hood. If you just glance at the front page of Yahoo Finance or whatever, you might just see a mild dip in the major indexes and think nothing of it. But as we dig a little deeper, we're going to see a very specific, highly targeted shift in how Wall Street is actually valuing the future of technology.
Because look, at first glance, a 1.3% drop in the Nasdaq, maybe a 0.7% drop in the S&P 500, that just looks like a totally normal, slightly cautious day in the markets. It's your standard ebb and flow. If everything were just being sold off equally, you wouldn't even blink an eye at this. It just looks like a standard risk-off session where investors take a tiny step back to breathe. But wait, look at this. Semiconductor stocks fell a massive 5%. Boom. That right there is our first major clue that investors aren't just broadly selling off the market, they are specifically putting a target on the back of growth-sensitive tech. A 5% drop in the semiconductor space while the broader market barely moves, that tells us there is a highly concentrated reassessment happening right in the beating heart of the tech sector.
And this brilliantly illustrates the real anomaly we're dealing with here. Look at how uneven this sell-off actually is. Memory and storage stocks, like SanDisk, Western Digital, Micron, they got absolutely crushed, plunging anywhere from 7 to 9%. Meanwhile, the literal poster child for the AI boom, NVIDIA, barely even flinched in comparison, falling just 2.3%. Why the huge gap? Well, AI data centers require massive amounts of memory and storage, but those businesses have entirely different economics than NVIDIA's GPU dominance. Memory and storage are highly sensitive to supply, pricing, and capital spending cycles. The market is suddenly and aggressively splitting hairs between who provides the compute power and who provides the storage.
So, who or what is the mastermind behind this targeted hit? What could cause investors to suddenly dump memory stocks while holding on to others? Spoiler alert, it is not a sudden lack of AI demand. It's the 30-year Treasury yield hitting a massive 5.337%. That's the plot twist. This isn't just a technology story anymore, it has suddenly violently become a macroeconomic story.
Here is the absolutely crucial point to understand. AI demand can remain incredibly strong, like off the charts strong. But if government bonds suddenly pay more, investors simply won't pay as much today for a tech company's future profits. Think of it this way. When you buy an AI growth stock, you're paying a huge premium today for massive profits that you hope the company generates 5 or 10 years down the road. But if a risk-free government bond is suddenly handing you over 5% guaranteed, the opportunity cost of taking a risk on that tech stock goes way up. The future earnings are just literally worth less today.
Let's trace this out because it's a direct chain reaction. It's honestly fascinating to see how global commodities end up hammering our tech portfolios. It starts with higher oil prices, right? Which naturally sparks concerns about rising inflation. When inflation fears rise, the market starts expecting the Federal Reserve to keep interest rates higher for longer. That expectation causes long-term Treasury yields to spike. And, as we literally just saw, when yields spike, the valuation multiples that investors are willing to slap on high-growth tech stocks just get crushed. It's a complete domino effect.
So looking at those steep memory stock drops we saw a minute ago, you kind of have to stop and ask the multi-trillion-dollar question. Is the AI infrastructure cycle actually finished? Like, are hyperscalers just done building data centers? The short answer is no way. You absolutely cannot make that claim based on one turbulent trading session. Remember, stock prices move because expectations change, not necessarily because the current physical demand for the product just vanished into thin air. So let's gain this out and look at the 3 potential scenarios of what might actually be happening.
First up, let's look at the bull case. In this highly optimistic scenario, hyperscalers like Amazon, Google, and Microsoft are still out there aggressively building data centers. Their needs for computing, memory, and storage are only going up. If this fundamental spending accelerates, then this entire sell-off is really just a temporary, maybe even healthy correction. It's just the market taking a quick breather to reset expectations before the whole underlying investment cycle goes right back to marching onward.
Then we have the base case, and honestly, this one feels pretty realistic to me. Here, the AI story definitely survives, but the easy money phase, yeah, that's completely gone. AI demand remains strong, but Wall Street becomes hyper-selective. Investors aren't just going to blindly buy any stock that has AI in the press release anymore. They start heavily scrutinizing who is actually generating cash and expanding their margins. Meaning fundamentally strong companies stay winners, but any stock that was previously priced for perfection is going to face absolutely wild volatility if they miss earnings by even a fraction of a cent.
Finally, we've got the bear case, and this presents a truly dangerous combination for portfolios. Imagine a scenario where the major tech giants actually do decide to slow down their capital expenditure on AI infrastructure. Suddenly, you've got an oversupply of memory chips causing prices and profit margins to just plummet. If earnings expectations decline at the exact same time the Treasury yields are remaining highly elevated, you're getting hit from both sides. Lower earnings colliding with lower valuation multiples, that could easily turn a 9% stock drop into the beginning of a massive sector-wide repricing.
So how do we figure out which of those three timelines we are actually living in? Well, you've got to watch the relationship between these specific metrics rather than just panicking every time the Nasdaq has a mood swing. If Treasury yields rise but AI capital spending and corporate cash flows are still incredibly strong, we're probably just seeing a valuation reset. But if yields stay high and we actually start to see cracks in semiconductor earnings or a real drop in memory pricing, that is a much more serious warning light flashing on the dashboard.
Which brings us to a foundational rule of investing, one that is perfectly illustrated by this whole mess. Business performance does not equal stock performance. A company can have a phenomenal, world-changing underlying business. They can literally be selling record numbers of chips. But if Wall Street's expectations were set way too high, it can still be a deeply disappointing stock. The market isn't grading these companies on how well they did yesterday, it's grading them against the impossibly high expectations it's set for them tomorrow.
As we wrap up this explainer, I want you to remember one thing. The artificial intelligence revolution isn't disappearing. The data centers will still get built, the computing power is still absolutely going to be needed. The real mystery, the one that's going to dictate the direction of the market for the next year, isn't about the technology itself. It is entirely about the math of expectations. Exactly how much of tomorrow's growth is already priced into today's market. So the next time you see a tech darling take a sudden dive, you have to ask yourself, is the artificial intelligence dream actually fading, or is the bond market just finally waking up?